In 2022, investors were confounded with a few major events that dramatically moved markets. We saw alarming levels of inflation in the US, levels that seem mythological in the years since the Great Financial Crisis. We then saw surprisingly aggressive Fed policy rate hikes in response. We watched China's property developers languish in policymaking limbo, leaving each company heading towards seemingly inevitable defaults, just at different speeds. We saw economic activity was stifled elsewhere across the country as China's zero-COVID policy arrested most other growth, bringing about its first recession since the late 80s and early 90s. We also witnessed a decades-long international norm violated with the invasion of Ukraine. Now, along with it, and among other things, we suffered shocks to global supplies of food and energy and introduced a new wave of geopolitical divisions and instability. Together, these and other factors drove interest rates generally higher and credit spreads generally wider across various markets. And that's a mix that conspired to produce considerable negative total returns, even in traditional risk-off safe havens such as US Treasuries. So in 2022, investors had little to no shelter at all. Now, we're still left with the same negative effects from the war in Ukraine, but 2023 otherwise looks a lot different. The property sector in China, for one, found some respite after policymakers finally offered a level of commitment and clarity that markets found comforting. President Xi abruptly pivoted from his zero-COVID policy, and normal economic activity has resumed faster than many anticipated. And authorities collectively have reaffirmed growth as a priority in China. In the US, while the Fed remains committed to its hawkish slant to contain inflation, the pace of hikes is surely slowing. And that leaves most market participants desperately looking for an eventual pivot there. Rates markets are still moving, but there's a lot less volatility than there was in 2022. Inflation, though, is now sharing a lot more discussion time with growth, and that's now because the lagged effects of policy tightening are starting to work their way through the economy. We're talking more about how long and how severe of a recession we might encounter, and that's in the US and in many other countries around the globe. In fact, in the US, we might already be in the early stage of one now. The stabilization that we've seen has encouraged many investors to look beyond cash and government bonds for their asset allocations this year, but those concerns about a looming recession in multiple countries worldwide leaves many reticent about equities and instead preferring higher quality credit on the fixed income side.
Asia is one of the brighter spots amidst the global recession current. The market consensus for 2023 global growth is 2.9%, with potential risk to the downside. Developed markets are expected to post 0.3% growth on average, with the Eurozone and UK entering contraction territory, and the US may only generate 0.5% growth with higher probability of disappointment. Emerging markets are expected to generate 4.7% growth, much stronger than developed markets. But if we look closer, the growth engine actually resides in Asia. Major Asian economies such as China, India, and Indonesia are all likely to register growth of around 5% or more, while emerging market countries fall in the 1 to 3% range. Three factors underpin Asia's growth. Factor 1, inflation. Asian countries have better control over inflation. This is on the back of Asia's location and position advantage in the supply chain and self-sufficiency of raw materials. With a less inflationary environment, Asian central banks do not need to raise interest rates aggressively to fight price pressures at the expense of economic growth. They have more flexibility to support the economy as and when needed. Now, many Asian countries may have reached peak inflation. Asian central banks may be among the first ones to pause their tightening cycle and consider turning dovish, a big positive for their economies amid global headwinds. Factor 2, foreign exchange reserves. Asian countries are also well positioned externally given their ample foreign exchange reserves. As a result of the U.S. Federal Reserve's hawkishness and strong dollar, Asian countries' foreign exchange reserves have fallen and led to market concern. However, when we expand the time horizon, Asian countries have built up a decent level of reserves since the 2008 financial crisis, and especially post-pandemic. The reversal in 2022 is relatively small compared to what has been accumulated in the past 10 years. This gives Asian countries greater resilience in a shifting global macro environment. Factor 3, China. China refocusing on economic growth has released strong momentum. Consumption demand is the priority, where the authorities aim to expand the middle class through common prosperity. The property sector has come back to life with strong policy support, including a 16-point plan and 4 arrows on the developer side, plus the lowering of mortgage rates and purchase requirements on the demand side. We have started to see signs of stabilization, including a recovery in property transaction and house prices. We expect to hear more concrete guidance in key policy meetings in March.
In addition to the arguably apparent fundamental advantages in Asia, investment-grade valuations are still relatively attractive versus those in Europe and in the US as well. While spreads in European investment-grade bonds are higher than those in Asian investment-grade right now, something that is not at all typical, overall yields are still notably higher in Asia. Against the US, investment-grade bonds in Asia offer slight pickups in both yield and spread, but do so with nearly 2 years shorter duration on average. So investors are getting slightly better compensation for the same average credit rating while taking considerably less interest rate risk. And even on their own, valuations in Asian investment-grade debt are appealing. Prevailing yields offer sizable buffers to negative effects from potential rate rises and potential spread widening. In fact, we'd have to see significant moves in both before we got to net negative total returns at current levels.
In the long run, Asia investment-grade bonds may add stability and provide good total return to investors' portfolio. The 5-year Sharpe ratio of Asia investment-grade bonds is higher than its investment-grade peers, as well as most equity asset classes. That means for each unit of risk taken in Asia investment-grade bonds, investors receive more return than other asset classes. Therefore, adding Asia investment-grade bonds to the portfolio can potentially enhance return with lower volatility. This risk-reward characteristic is the result of the inverse correlation between U.S. Treasury yields and Asia investment-grade spreads. In a risk-on scenario, higher U.S. Treasury rates are offset by tighter Asia investment-grade spreads, whereas in a risk-off scenario, wider Asia investment-grade spreads are offset by lower U.S. Treasury rates. Therefore, investors can receive consistent yield in the long run by adding defensiveness to their portfolio. Now, Treasury rates are at historical highs, but upside risk is limited given lower inflation expectation and increasing recession risk. And this is a good opportunity to capture the higher yields while limiting the downside risk. From a macro angle, Asia possesses the largest growing markets, for instance, China and India. There are risks when venturing into ever-changing markets, but Asia investment-grade issuers' solid credit profile, such as healthy leverage ratios and ample liquidity buffer, provide investors a more defensive choice to participate in Asia's growth potential. By assessing the global macro backdrop, we are close to the end of the rate hike cycle and may soon need to rack up our rate cut expectation because of recession risk. Therefore, while riskier asset classes may be under pressure, an allocation to Asia investment-grade bonds, which will benefit from rate cuts, may help investors defend against the recession headwinds.